All right, hello and welcome to Camel Finance. I'm your boy Camel, and today I got a bunch of questions that came up from yesterday's video in all shapes and sizes. So I'm going to go through these. This bottom one is a bit of a long one, but it shouldn't take too long to go through. So without further ado, let's get into it. First of all, there's this FTX sell-off that could well be a narrative, and allegedly they've got around $200 million worth of Bitcoin that could be about to be sold as of September the 13th. And a lot of people are saying, you know, that's it. Get ready for 18K, get ready for 9K, get ready for 12K. I even saw a Gareth Soloway call for 3.5K Bitcoin or something. But what do I think of this? Well, I think this could potentially be a narrative. But 200 million for Bitcoin is actually nothing. Okay, this could be absorbed and you wouldn't even see it in the price. So if you're thinking that 200 million is enough to crash Bitcoin's price, then just go and look at the daily transaction volume on big candles versus the small ones. You'll see that that can be hoovered up without even being noticed. So I don't think 200 million is enough to crash the price. In fact, let me rephrase that. 200 million is not enough to crash the price of Bitcoin. But could this end up being some kind of fear FUD narrative campaign? Yeah, it could be. So we'll have to be open to that. Ultimately, I do think since CPI is on Wednesday, that will be the driving force behind the markets. Next, Wick versus 25K breakdown. I have been very, very consistent in saying I'm bullish above 25K in yellow and bearish below it. But there is a small caveat to this. If we were to wick this and V back up very, very quickly and then push off, then that would just be a challenge to deal with. That would just be kind of horrible, but also well within the realm of standard price behavior for Bitcoin. Bitcoin likes to wreck everyone before it gets going. So the caveat to this is if we wick down here and then immediately recover and go full bore bullish melt up mode, then I remain bullish under this scenario. But for me, the bearishness, I become bearish on a breakdown below it. That means something like this that consistently stays under and then works its way down. So 25K for me is the line in the sand. It's probably the line in the sand for a lot of people. But like I said, there is a caveat to this because if we did just get some kind of wick that then immediately recovers and blasts off, then of course that would just simply be a liquidity grab. And that is actually something that would be healthy and conducive to a massive upside push. So that's the difference between the breakdown where I become bearish versus the wick, which is of course just everyone getting wrecked before we move higher. Should probably point out here, in either scenario, it doesn't really affect the positioning because as you can see, we're lining up a blue trendline breakout. So if we wick and recover and break out, then we get long on that breakout right there. Doesn't really change much for me personally. This question right here is probably my favorite question of all, so I'm going to save that till last. A couple of people wanted me to cover some charts. Now, we don't really do altcoins here, but I'm going to make an exception this once. Here is Chainlink for you. We've got a squeezing and a range. Now, the person, I think Sean, that flagged this to me said he's done great at buying at 6 and selling at 8. That's not for me personally, although of course there's absolutely nothing wrong with that, and that would have been a fantastic strategy, providing you with many, many opportunities to make some nice, healthy gains along the way. For me personally, I would want to see a trendline break denoted by this long position here. I'd want to see something like this, breakout, retest, resumption. That would be the trigger for me personally. So that's Link dealt with. Someone else asked me to cover XRP, so here it is. I noticed this, right? This massive, massive, massive macro wedge that is forming. I do think this is probably going to break out at some point. When is anybody's guess, but I would think something like this is coming. So of course I could be wrong about this, but for me, a trendline breakout at the top and potentially even sooner another trade opportunity will arise. And I do think XRP is probably going to do something like this. So it is what it is. That's my opinion. Had a request for natural gas. So here it is. For me, it's still in this range, isn't it? It needs to break out above this. Something like this would be decisive and could be a long from me, but all the while we're in this range. And frankly, there's another area of interest here, isn't there? We need to get above that before we can really start to say there's a good run for nat gas. But this certainly looks like the making of a bottom at the moment. The problem is, that I have with this at least, is there's really nothing to say that this bottom won't end up taking months and months and months and months and months. So for me, there's no trade here, but each to their own, of course. We also have IONQ. I've never really heard of this, but it looks pretty good, doesn't it? We got this uptrend and potentially looking to emerge from a base at the top. So get above here, and I think the thing is bullish. For me, the exit for any trades on at the moment would be a breakdown of this upward sloping pink support line. And lastly, SMCI. So we're going to have a quick look at this. As you can see, is this breakout retest looking for that resumption higher? Quite possibly. We do have to kind of be open to seeing this morph into some kind of head and shoulders top. So that's something to watch out for. And of course, a confirmation of that would be a breakdown of this right here. All the while we're above the support in pink, this upward sloping one. then I think you could stay long if you were in longs, and you could potentially even look to get long, and the long could look something like this. So with all the chart requests out the way, I want to deal with this next question regarding the ETF. I have covered this a couple of times before, but let's be really clear on this. So can I explain the difference in the ways they could use the ETF? So scenario one, using the ETF as a distribution tool, and scenario two, using the ETF to allow the price to skyrocket. I'm going to do this one first because this one's pretty simple. Okay, so here's gold. When the first ETF for gold was approved, as you can see, the price went into orbit. So how would this work for Bitcoin? Well, very much in the same way. What we would see if a bunch of spot Bitcoin ETFs were approved under this scenario would be they launch a bunch of these spot ETFs. Every time somebody buys the ETF product, the ETF manager like BlackRock, Fidelity, Vanguard would have to go into the spot market and buy Bitcoin in a 1-to-1 ratio. So if you bought one Bitcoin's worth of ETF, of course, they would go into Coinbase or wherever they use, and they would need to buy one whole Bitcoin on the spot market. Of course, this would put massive underlying buy pressure on the price of Bitcoin, just like it did here, and happy days, right? We would get this big parabolic advance. The price of Bitcoin would go into orbit. Of course, there is plenty of speculation out there that huge inflows, incomprehensible inflows would make their way into the Bitcoin space because we have pension funds, insurance funds, family offices, sovereign wealth funds. The list goes on and on forever, right? All of these massive, massive, massive types of financial institutions would be able to have access to Bitcoin and thus put pressure on the Bitcoin spot market. So this would be scenario one, that they approve the ETF and the price of Bitcoin goes into orbit as demand goes through the roof, as billions and even trillions flow into Bitcoin. The other scenario is the more nefarious one. And this is to use the ETF as a distribution tool. It's also possible that they do what they did with gold and combine both of these. So they allow the price to go into orbit, and then from around this point onwards, they use the ETF as a price suppression tool. So let me explain how this works first of all. If you go into any kind of ETF provider or fund provider, so there's HL here, this is just one I'm familiar with. But the point is, if you search for any kind of ETF or ETC and scroll down, you will find a key information document, a KID, okay? Now, if you know what I'm about to do, then all credit to you. And if you don't know what I'm about to do, then you're going to have your mind blown by this. And once you have your mind blown by this, I encourage you as a self-development and a self-learning tool to go and do this this experiment for yourself. I want you to go and do this experiment. Go and find your favorite ETFs. I don't care whether it's tracking gold or the S&P or something very abstract, but go and find your ETF provider that you use. Have a look at your favorite one and go and find the key information document. So here's the KID for this particular gold ETC. Now, it doesn't matter if it's an ETC or an ETF, they're all practically the same. But the point of this KID is it's supposed to provide, in a standardized format, a simple way for investors to understand what they're buying, okay? So it has things like a table of fees for entry and exit costs. It tells you what your expected returns could be, blah, blah, blah. But something every single one of these KIDs has that probably many people can't even be bothered to read are some statements that point out the problem with ETFs. And inside all of these risk indicators, it will say things like this. If we are not able to pay what is owed, you could lose your entire investment. Under here, you could see what could negatively affect my return. And they list all the things from unfavorable market shift or conditions or market perception, interest rates, yields, foreign exchange rates, and then note this bit, okay? The credit worthiness of the transaction parties and service providers in relation to the ETC or ETF security, okay? So again, they're letting you know right here on the key information document that if they mess up, if they go broke, it's on your head, okay? This is not the same as holding physical gold. If you hold paper gold via an ETF and they go broke or they decide you can't have it, that's the end. You could lose all of your money. Unlike holding physical assets such as Bitcoin on cold storage or physical gold and silver, where they carry no counterparty risk. If the ETC security is redeemed under severely adverse market conditions, this may lead to a reduction in the value of the ETC security and the investor may receive zero. Let me say that again. And the investor may receive zero. Okay, so this is the problem with paper gold. It's also quite a well-known fact that the amount of claims on gold, the amount of ETFs held on gold outnumbers the amount of gold in the vaults backing these ETFs by 10 to 1. Okay, that means for every ounce of gold that's supposed to have your name on it, there are 10 investors holding an ETF with that same claim on that same 1 ounce of gold. So one more time before I move off of this subject, what happens if the investment is unable to pay out? Okay, DWS Investments UK Limited, as packaged retail and insurance investment products manufacturer of the ETC security, is not obligated to make any payment in relation to the ETC securities. If DBETC fails to make a payment when due, the trustee can enforce security over the metal deposited with the custodian. Once the trustee has enforced the security, it can sell the precious metal and the use of the proceeds of this sale to pay the amount that's owed to you under the ETC securities. But the proceeds of such sale may not be enough to cover all the amounts that are owed to you under the ETC securities. The product is a debt instrument and as such is not covered by any deposit protection scheme. So, like I said a minute ago, if all of this is new to you, if you didn't know this is how ETFs and ETC works, I encourage you to go and look at all your favorite ETFs, probably the ones that you hold. If you hold any, they probably all have this written in them. I've never really seen one of these where it says, yeah, it's all backed 1-to-1. We promise we'll pay you. They all have this disclaimer in there that say, if we go broke for our own incompetence and chicanery and over leveraging and allowing people to have 10-to-1 claims on every ounce of gold we have, then it's you that pays the cost. Why would it be them? Of course, the entire system is like this. This should not be a surprise to you, but I bet you it is in many cases. So how could they use the Bitcoin ETF as a distribution tool and a price suppression tool? Okay, let's answer this question now using this chart right here. Let's assume that the likes of BlackRock and Vanguard and Fidelity, the ETF providers, have all accumulated massive amounts of Bitcoin in this neighborhood right here, and probably even continue to accumulate it around these current levels. Let's assume that they do that, right? They're now sat on a massive stack of Bitcoin. If they were to blow the price off, as this fractal suggests, once we get higher up, when people come to buy the ETF, instead of going into the spot market and saying, yep, this person just bought 1 Bitcoin's worth of ETF, so we will now go and buy 1 whole Bitcoin at the spot market. Instead of doing that, they can sell the Bitcoin that they paid 15K for to these people at much higher levels. If they continue to do this, it means they could be able to offload the Bitcoin that they bought down here at these lower levels at much higher levels, and the ETF holders would be still holding Bitcoin, right? But it would not be putting pressure on the underlying spot market. Now, couple this with the fact that, like I just showed you, these ETF providers have a history. In fact, like I said before, I've never seen one that assumes its own liability, assumes its own responsibility for the product and their behavior. They all have these lines in them that say, yeah, if we mess up, it's on you. So why would the Bitcoin one be any different? I don't think it would. So by removing the demand from the spot market and selling the Bitcoin that they accumulated down here to the ETF investors up here, we could quite possibly see a distribution setup until eventually there's no more demand on the spot market. All the Bitcoin that's down here has been distributed to ETF holders, and all the ETF holders have bought Bitcoin at the top only to watch the price melt down and roll over a multiple year period. Of course, after the price has fallen a certain amount, the people that paid for the ETF and are now sat on a 30 or 40% loss are going to have to start to manage risk. They're going to have to start to offload their ETF. So then as they start to sell the ETF, this creates more sell side pressure on the price of Bitcoin, and we get a cascading sell-off of ETF sellers and spot sellers and panic sellers, and everyone just gets completely wrecked the whole way down. Now, back when we get to a much lower level, the game can be played all over again. The likes of the ETF providers can step in and reaccumulate the Bitcoin much lower down, and finally they can go back to backing their Bitcoin ETFs with actual Bitcoin. However, like I just showed you, history is not on our side for assuming that they're going to do this in a 1-to-1 ratio. We know there are 10-to-1, and there are certain ETF products out there with 20-to-1 claims on each ounce of gold. So is this likely to happen with Bitcoin? I would assume so. And if you're wondering why I assume that, it's because why wouldn't it, right? Why should we expect them to have such foul play with gold? And then when it comes to Bitcoin, suddenly we're just going to expect them to start operating in an open and honest and fair manner. I just don't see that happening. I see them repeating the same old tricks, just with a digital gold instead of the physical gold. And so this is how I believe we could see the old gold trick played on Bitcoin, right? And by the time we get down here, Bitcoin will probably enter a new 3-year or 4-year bull market that then, undergoes its standard 4-year cycle shape again. And there will certainly be money to be made playing these cycles. But if gold is anything to go by, after we had the initial surge of the ETF, you can see gold really did absolutely nothing for well over a decade. It is still not surpassed its all-time high. It's still not holding above its all-time high. We are still in this massive, massive, massive sideways range for gold. So is this a way that they prevent retail from exiting the system with Bitcoin? Is this a way that they suppress the price of Bitcoin through the ETF? Quite possibly. So to go back to this question, I think I've answered how they could do this in each scenario. You were under the impression that the ETF is just a service, and it is just a service, but that does not mean they cannot manipulate it just in the way that I've shown you with gold and so on. Will they be able to sell more Bitcoin than their customers own temporarily? Yes, as I've shown you that, they could accumulate, and then instead of going to the spot market at the top and buy a 1-to-1 ratio, they could just offload their Bitcoin that they paid 15K for at much higher levels. Of course, that would strip demand from the market as well. Does this mean they would be front run selling the customers? Yes, absolutely. And then the customer sells the ETF share? Yes, absolutely. And technically it's the same Bitcoin? Yes, absolutely. This is complete scammery. And like I said, this is just how it works. So to finish answering this question, if Coinbase is going to be the custodian, who are the ETFs selling their Bitcoin to? Well, the custodian simply means they're holding on to the Bitcoin for them. So BlackRock obviously have massive ownership of Coinbase. They have a partnership with Coinbase. In fact, I saw something recently where they put in their Aladdin system, which has been used to accumulate a lion's share of basically every market on the planet, to work with Coinbase and the Bitcoin market. So I fully expect them to ultimately end up having the lion's share of the Bitcoin supply. But who are the ETFs selling their Bitcoin to? They're likely just changing hands between Coinbase, which is owned by BlackRock, and BlackRock. So i.e. they essentially will be wash trading them in and out of their own accounts. And of course, in the process of doing this, they will be taking it off of retail and putting it into the hands of the controlling elite, as they always do. Wouldn't BlackRock want to hold their Bitcoin indefinitely? So buying and selling is just between customers. I think the answer to this question is they don't necessarily want to hold the Bitcoin indefinitely. Instead, what they want to do is accumulate as much of it as possible so they can control it. And that includes Coinbase, that includes all the miners that they've been buying up. They're just going to want to try to control and dominate as much as possible. So it's not necessarily they want to hold it indefinitely, it's that they want to play as many games on the public and engage in as much foul play as they can until they own the vast majority of the supply. And finally, unless there's some crazy incentive, the 75% of the long-term holders right now probably won't put their Bitcoin into the ETF to help BlackRock manipulate the market. So how would that affect the whole thing? This is a very, 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 very good point. Okay, this is an excellent point right here. 75% of the long-term holders are holding the supply. 75% of the supply is held by long-term holders currently. Now, if you're in it this early, if you understand what you hold, if you cold store your Bitcoin, if you take true ownership and you don't carry counterparty risk by bearing your own Bitcoin on a cold wallet, then you're right, this does not affect anything. If everybody decides to actually bear the true bearer asset, which is Bitcoin, then BlackRock are really going to struggle to accumulate a lion's share of this market. And right now they don't have a lion's share because 75% of the supply is held by people like us. But remember, as prices go up, long-term holders become more incentivized to sell, and ultimately BlackRock are going to do everything they can in their power to try to take the Bitcoin off of retail. This is also why I think this whole 1 year up, all-time high before the halving, followed by a 3-year bear market decline is quite likely, because that is one surefire way to make everyone think that Bitcoin is broken. Once it starts to undergo a completely different shape, people are going to panic sell their Bitcoin. People are going to want out of this market. And of course, BlackRock is going to be waiting there to hoover it up. Going back to the gold ETF, if the majority of gold was held in physical bullion and in your hand, then it would carry no counterparty risk and you would not be subject to losing all of your money in a gold ETF should it collapse, right? You would not be subject to these sentences they put in where they say, if we can't pay you, you may receive zero. Investors may receive zero, right? We wouldn't be subject to this if you hold your own physical bullion in your hand. And of course, the same is true of Bitcoin. If you cold store the Bitcoin and you hold that yourself, if you hold your own keys, you won't be subject to the games and you won't be subject to BlackRock taking your Bitcoin. But this is why the education of Bitcoin is so important. This is why it's super important that people do not sell their cold stored Bitcoin for the ETF. I don't know why you would, frankly. I think if you had a pension fund, I know a bunch of you actually, because you've commented on this, and I would probably do the same. If the Bitcoin ETF gets approved soon, I will probably use it to just become even more all in on Bitcoin, right? There are certain accounts that I have that I can't access Bitcoin with. And if they have a Bitcoin spot ETF, then would I buy some of that so I could be even more all in on Bitcoin? Quite possibly. Right? There are certainly pension funds, like I said, family offices, sovereign wealth funds, hedge funds, banks, pension and insurance funds, all of these types of funds probably want some exposure to Bitcoin, and the ETF does open that up as a possibility. But just like with physical gold being infinitely superior to paper gold via ETFs, physical Bitcoin is infinitely superior to paper Bitcoin via ETFs. So it does remain to be seen whether or not we will get the approval of the spot Bitcoin ETF and a massive overperformance, or whether we will get it used as a price suppression tool. It could even be, like in gold's case, that we get both, right? We get a massive price explosion followed by suppression and sideways for years. As always, education is key. Understanding what you hold is key. Cold storing your Bitcoin or holding physical bullion in your hand is always superior to paper investments because they carry no counterparty risk. So I hope that answers your questions for you. This one is my favorite and I've saved it till last. So here I have the S&P 500 at the top, priced in the M2 supply, the money supply. And the question here is a very, very good one, right? If we draw this box at the top, you can see going back to 2017, the S&P 500 has not actually gained in value, okay? All it has done is traded in this massive range versus the S&P, which is priced in dollars on the bottom chart here in orange, which you can see has allegedly increased to today's price at least 71% and 84% going back to the prior all-time high. So this question is, when you price the S&P in the money supply ratio, does it actually mean we're not growing except for money supply for decades? So flipping into a weekly chart, we'll be able to see this much clearer. If I grab this and extend this out, you can see that going all the way back to 1996, which is the edge of this box, we haven't really outpaced or set new highs, have we? We've just come up to this level and dropped. We've come up to this level and dropped, up to this level and dropped multiple times. Whereas if you were to look at the S&P 500 going back to that same time, 1996, which is at the bottom right now, you can see this is allegedly up, priced in dollars at least, 500 to 600%, depending on whether you take today's price or the prior all-time high. And this is a point I have made multiple times on this channel before, is that there are only two asset classes that are actually outperforming the money supply. So first of all, let me back up here and explain what this really tells us, just in case we're not clear. At the top, what this tells us is that the S&P 500, whilst it looks like the dollar price is going up, whilst it feels like we're getting rich by holding the S&P 500, the top chart shows us that all it is doing is barely keeping pace with the infinite increase in money supply. That is to say that the S&P 500 is not actually appreciating in value. The dollar is being debased against the S&P, and it's just about keeping up with the rate of debasement. Okay, so to say that again, that explains why when you look at your portfolio, the number keeps going up, but you're not any richer, right? You still can't buy a bigger house if you just track the S&P 500. You might have more dollar value in your S&P 500 portfolio or in your S&P 500 tracker, but you're not really any richer, right? And this is exactly why, because priced in money expansion, priced in M2, as you can see here, the S&P 500 has traded sideways and has only just about kept up with the rate of inflation since all the way back to about 1996. So here's the difference with the NASDAQ. Since the great financial crisis, since the end of the bear market, the NASDAQ has been in an uptrend when priced in M2SL. Okay, so the NASDAQ has actually been growing against the money supply rather than trading sideways, as I just showed you with the S&P 500. So big tech is outperforming the rate of inflation. That is to say, instead of holding the S&P 500 and just preserving your wealth and barely keeping up with the rate of currency debasement, by holding tech stocks, you will have actually gotten richer. You will have actually increased your net worth. Here's that same chart for the Dow. As you can see, the Dow not outperforming the rate of inflation, right? Not outperforming debasement, simply barely keeping up with it, actually. Less significantly keeping up with than the S&P 500. And finally, here is Bitcoin divided by the money supply index, M2SL. And what you could see is quite clearly there has only been one king during this entire prior 13 or 14 years now. Only big tech, the NASDAQ, tech stocks, and Bitcoin have outperformed the currency debasement, the inevitable journey to zero that fiat currency is under. This is why I spend 50% of my time on this channel talking about Bitcoin, whilst the other 50% roughly is spent on trading. The main reason for this is because, and I often say this, Bitcoin is the exit. Look at that, okay? Only people that bought Bitcoin and held Bitcoin have been able to rapidly and vastly and significantly outperform the currency debasement when measured in the money supply. This is the same if you look at the central bank balance sheet. If you price these assets, and you can go and do this in your own time, go and price all of these assets I've just shown you in Fed balance sheet. And what you will see is only big tech, i.e. the NASDAQ and Bitcoin, are outperforming. There are only two assets to hold at the moment, and there have only been two assets to hold over the last couple of decades, and they are Bitcoin and tech stocks. Everything else, at best, has simply kept pace with the rate of debasement, and thus you have not gotten richer, you've simply managed to hold on to your wealth. So this is an absolutely fantastic question, and it does beg the question, what really is the exit? And of course the answer is only big tech and Bitcoin are the exit. Of course, of the two, only one of them is possible to hold with no counterparty risk, as we said earlier, and that is of course Bitcoin. So my throat hurts, which means this is probably going to be a bumper episode. Just before I say goodbye, I posted this to Twitter yesterday and I wanted to show you this. Look, GBTC, which is in orange at the top, is posting divergence with the Bitcoin price at the bottom in candlesticks. And the last time we saw this was in early March back here. You can see the orange, we had a divergence up whilst the Bitcoin price went down. And what happened shortly thereafter was Bitcoin went on this big upside rally. It followed GBTC. Note, this time this is occurring. It's happening at a time when the 12K callers are out in full force. Okay, so I do wonder if this divergence is going to continue. Does that mean we're going to get a repeat? Does that mean we're going to get something like this for the price of Bitcoin? That's certainly what happened last time. Last time this happened, I pointed this out back here as well. And I said, look, this is interesting. Usually when we get divergence in GBTC, Bitcoin's price followed. Last time it did. And now here we are again, approximately 6 months later, we are getting this divergence show up. And again, this is another biomarker to tell us that an upside pump for Bitcoin could well be loading. We have more evidence here that the dollar may well be about to peak. It's right around that neighborhood where we should see some distribution and a rollover. We know 3-year cycle low is still predicting down for the Dixie and is not due until Q1 of next year. I'm your boy Camel. I don't really know what happened today. I, to be honest, just wanted to answer some questions and it feels like I've been talking for ages. I have really no idea how long this is going to be, but I hope you enjoyed it. I hope you found value here today. I'm pretty sure there was some alpha hidden in here somewhere. Obviously, everything I said in yesterday's video still holds as it's Monday, but I wish you all the best week possible. And until next time, take care from me. All the best. Cheers. Bye.